Welcome back to Switzer on Sky News Money. Banks have been sold off in recent weeks on the back of the levy, lending restrictions and buyer regulations. Bank share prices are down double digits, but my next guest is not concerned and believes that the bank sell-off is good for the Australian market. His name is Rudi Filapek-Van Dijk and he joins me in the studio. Rudi, welcome.
My pleasure, Marty. I bet you don't see too many people coming here and go like, bank selling off is a good thing.
First time I've heard it in a while, so when we had a chat this morning on the telephone about what we're going to talk about this evening, I thought, I'll look forward to this conversation. So before we get into that and why it's a good thing, selling may go away, seems to sort of be playing out. You know,
yes and no.
Will it continue?
Yes and no.
Or you expected more of a sell-off?
Well, selling May this year has only been important if you're stacked up with banks, essentially. If you,
which most people are.
If you have, well, depends. Fund manager follow the index, yes. A lot of people, SMSFs
a lot of investors watching this show have exposure to banks.
That's true. But if they have a broader portfolio and own a lot of other stocks, name CSL, Ramsay Healthcare,
all weather performers,
technology ones, exactly, and also other stocks like Aristocrat, Leisure, you name it, they wouldn't know about Seller May. They would have a really good month. Like for example, my portfolio has had a crack of a month. So
you don't have any banks in your portfolio?
No.
No banks?
No.
No income?
No, that's not true. I have income, but via other means.
Okay.
I have other stocks, okay. And that means.
Love to see your portfolio already.
There you go. It means Seller May. I don't know what you're talking about. I go like, really? I have no idea.
It's going up.
So, and
the large caps are saying have been impacted.
Well, certain large caps.
Okay.
Yeah.
Banks and resources.
Exactly. What we've seen is the resources have corrected since February. The banks have waited a little bit longer. I do think, and I think people have underestimated this. I think, but I did point it out when it happened. I think the bank reporting season really made a switch in the mindset of investors. I mean, share prices went up, were pretty high, hadn't been that high since May 2015, and then the results came out, and the results simply were not good enough to justify those share prices. So the mindset has changed of investors. That has, and this is why it's a good thing. Late last year, running into this year.
That was my second question, but anyway, go ahead.
Okay. Well, I just made it. You don't have to ask it.
There you go.
I'm already answering it.
Yeah, that's it. You're ready in my mind, Rudi.
Previously, face value, the share market, it's having a good time, but it's actually quite a small basket of stocks doing all the work. I mean, the banks, some of the other financials,
large cap,
the resources. I mean, they're doing all the work, which means that in the second and third tier of the market, where a lot of good industrial stocks are, nobody was paying attention and nobody was doing anything there. So those stocks were not doing anything. To, you can say, frustration of fund managers. I mean, I was waiting as well. You think like it's not going to last. It will change at some stage. I believe that now that the resources have corrected, and the banks are now all correct now. And all of a sudden, people look at the banks and go like, you know what? There's a bad news cycle which has opened up now. It's not going to disappear anytime soon. So now the attention will move to the rest of the market, and it already has happened since the middle of April.
So the banks are buy?
No.
When will the banks be a buy in terms to the Van Dijk valuation model?
The banks are definitely the logical observation to make. They're more attractive than they were a month ago. But they're not a screaming buy yet. They still remain in a bad news cycle, which I think still has further to run.
Yeah, there's still a lot of negativity out there.
Yes, exactly. So there's downside protection because they won't cut their dividends, and if they're really forced to, it will be by a few cents. Yeah? It won't be a BHP experience where they have to 40% off or something like that. So there will be downside protection, but there's no reason unless we get a new reflation trade like we had last year, which is basically a global phenomenon, then there's no reason to jump immediately in the banks or, I mean, to expect great things, which is hence my reason why I think it's a good thing. What now is going to happen is everyone who wants his money to work for him, and he doesn't have to go overweight banks now, so the attention will go to other stocks, I mean, to the likes of...
they'll say sort of index weight banks?
Yes. Or maybe a little bit underweight.
Yeah, but accumulate other sectors that are performing. So
which
then rotation into small caps, is that what you're saying?
Exactly. I think it will now trickle down to the second tier of industrials, predominantly, which have a good story to tell, which have a lot of growth under the wings,
Like who?
Well, Altium, for example.
Who?
Altium.
Okay.
Company called ALU.
Okay.
You have the likes of a Webjet, corporate travel, Aristocrat, performing really, really well. You also have, you would have stocks like a Bapcor, for example, which is not quite deservedly thrown in with the retailers and sold off on that reason. But there's quite a number of smaller cap industrial stocks which hasn't had full attention of investors. And they're getting attention now. You see it now.
So what are the back to, because obviously our viewers love income.
Yes.
You know, the hunt for yield is never ending, particularly with the army of SMSF investors. So in the Van Dyke, Philip Peck Van Dyke portfolio, where you own no banks but you get income from other areas, I'm sure that everyone's here listening saying, where does Rudy get his income from?
Well,
could you share with us?
Yeah. For example.
What sort of you know, franked up sort of returns you're getting?
For example, I recently added a company called Viva Energy.
Okay. What's the code?
VVR.
Viva Energy, yeah.
Yes, and essentially, this is it's not listed for that long, but it's essentially an operator of petrol stations in Australia.
Okay.
And they're expanding in aviation fuel. It trades as a REIT, so basically it's a yield play.
Okay.
It's a relatively stable, solid story because it's inflation protected. You're not going to lose your income out of petrol stations anytime soon, and it's sort of has been trading sideways for this year, largely. Has gone up in recent times, so I'm not adding any more. I have my shares now. But if there's any,
what sort of incomes are paying?
It would
yield
5.5.
Okay.
So it's a bank-alike income.
Without before franking?
I would have to look up. Yeah.
Oh, there's no franking in it's a REIT.
Yes,
so there wouldn't
there's no franking.
Correct.
No.
Yeah.
But it still has 5.5%,
Yeah.
and obviously it grows. It has more growth under the belt than the banks have, right?
Okay.
And obviously less of that regulatory risk. That could be an example of an alternative way.
Yep.
And these guys are probably on acquisition trail still, so they can add value.
So Wesfarmers today copped a bit of a flogging, downgrade from the guys at Morgan Stanley saying it should go to an underweight.
Yeah.
Concerns over Amazon.
Essentially, yes.
Yep. Yeah. Slowdown in mining, housing.
Yeah.
Woolworths improving. Threats from other players.
I think what you see in Australia now is because CLSA also had a report out today. What you see now is there is an emphasis now on the potential problems that might come to the surface in Australia, and it all starts and ends with consumer spending. And obviously, the consumer is getting a little bit more hesitant, let's call it that way, and that will have a trickle-through effect on basically on a lot of companies who are directly affected by it. And
also too, I think that the consumer. While some of the data might say they're getting hesitant, they're spending, but they're just spending in different ways.
Yes, so, well, yes.
The people will shop, like a lot of people will shop and buy their clothes online from overseas.
Yes, cheap. And also what you will see is that previously they would simply extend or renew a subscription or an insurance policy or something like that.
Wouldn't ask a question.
And now, they're shopping around and they go like, am I going to renew my Medibank Private or am I going to look for something?
Check out HCF.
Exactly, something like that. So that element in itself is creating different dynamics now, and you see that in pressure on margins and on revenues now. And that is trickling through the share market now. And if that lasts longer, of course, then we will get all kinds of other, and that also is reflected in the banks. I mean, the banks are derating because of that as well, because the next time is that the banks can't just continue repricing their mortgages, and the next thing you know is that their bad and doubtful debts start rising, and that will definitely spook a few people.
So before he went away, I was having a yarn with your friend and my father, Peter Switzer, and I just got a flashback. He said that he believes that he had big news that Rudy is bullish at the moment.
Well,
is that true? Did you tell him you were bullish? And if so, why are you bullish? And are you still bullish? Because you could be bullish for a very short period of time.
That's not true.
No?
I've been positive about this market for a long time.
Good.
But there are times to be bullish and there are times to be cautious. And there are times, unfortunately, when you really have to be careful with things.
Yeah.
See, here's the thing. Bullish is a relative concept. If the problems that we now are encountering in the top end of the market, and we named a few, the banks, Wesfarmers, the resources, that's top energy stocks. Yeah? As long as that doesn't translate into a genuine risk-off situation, investors like myself and others who have the second and the third tier stocks in the market, the high growth, robust looking, reliable industrials, they will continue to do well. So I believe that if you have a weak June, and like we had a weak May, and it's only affecting on the likes of Fortescue, BHP and the banks, I'm not too worried about the prospects for the share market. I couldn't care less if it goes to 6,000 because at the end of the day, I have individual stocks and I don't have a reflection of the index. But those stocks are doing well. But again, it is possible that we do get a genuine risk-off situation in June. And then, of course, then there's no hiding them. Then the whole market will simply go down.
Rudy, thanks for your time.
My pleasure.
That's the show. If you want to read our thoughts each morning at the close of Wall Street, check out our website at switzer.com.au. If you want to get our thoughts on super, go to the Switzer Super Report where you can get a free trial. And if you've got any questions for me or ones you'd like me to put to an expert, you can email me, marty@switzer.com.au, or you can also follow me on Twitter and the handle is @MartySwitzer. I'm Marty Switzer. Thanks for watching.